Hey guys, I'm Jay. Welcome back. This is smarthelping.com. We've got another financial model here, full simulation of a data center. We're going to get into it. Full assumptions for development, Capex, 4 different revenue streams, including managed services, all kinds of variable expenses, OpEx, full financial statements connected, income statement, balance sheet, cash flow statement, discounted cash flow analysis, up to 10 years, visuals, all sorts of stuff. So what I'll do is I'll go through each tab, explain how to use the model, and then if you want to download it, links in the description box below. We will start with the global control tab. And so throughout the model, you'll edit all cells in blue text with yellow shading in the cell. And we'll start here, company name. This just goes on top of the financial statements. The forecast period, you could go up to 120 months. I'll change this. We built this off a 20-year model. It's now a 10-year, so up to 120 months at maximum. You could select any month time frame up to that point, and the model will adjust accordingly. You can also choose to include the terminal value or not, and it's going to be based on a multiple of the trailing 12-month EBITDA against the forecast end period. You can also put the first month forecast here. This is not really going to do anything except for give you a display just so you can see what month number one actually is. And the only reason why that's relevant is for seasonality. And seasonality is, um, well, scratch that. I don't think we need seasonal. Let me see. We have utilization. No, don't worry about seasonality. This just populates above on the income statement just to show you what month it would be, but it doesn't have to be the first month of the year. It could be anything. Seasonality was for the base template I used this from was the renewable energy model we just did last week for, what was it? I can't even remember. Um, oh, electric, what was it? Um, oh, solar farm. Sorry. It's been a long week and it's a Sunday night. Anyway, you can put the date here if you want. It's just going to show at the top of the financial statements here, but it's not going to be relevant for anything else. Most of the model is just driven on the month number that things happen. Um, Rest of the stuff here is just pulling from different tabs. You've got your income tax, capital gains tax rates here that might be relevant, or you could zero these out if you're doing pre-tax, and all your sanity checkers down here to make sure everything balances out, including the balance sheet itself. Executive summary tab, we're going to see high-level views of all the different key metrics. So occupied racks over time. And this is a data center, which means you build a building that has racks that you rent out and provide services to clients for. So as there's some maximum capacity there that's utilized over time, and these are all the different revenue streams: total revenue, direct costs, including depreciation, which would be your capex. Here's the depreciation component broken out, and gross profit if you don't include depreciation. Also, other fixed cost expenses, G&A, sales, marketing, R&D, total expenses, EBITDA, other cash flow items, final cash flow per period, and your project internal rate of return, total equity required, total project cash returned, equity multiple, total ROI. And there is an investor option view and owner option view. If this is some sort of joint venture, you can configure that. Now let's get into the actual core assumptions. So first, build out tab. You can enter up to 15 different CapEx items. You enter the total cost of each item here. And then you can also do a contingency, which is just a percentage of this total. And there's your total CapEx. And then over here on up to a 48-month schedule, you can define when those costs actually are incurred. And that will affect your cash flow. So if you had 50% month one, 50% month four, then you have half your spend happening in month 1 of that total amount and the other half in month 4. You can configure these percentages in any way, or it could all be in month 1, or what have you. You could have one build out. You might have a refresh of to keep your components fresh. You might have Capex over time that happens. That's fine. You just put in the entry and define the percentage of that cost that happens in a given month, through up to 48 months. Revenue. We have 4 revenue streams: rec, rent. So this might be an all-inclusive number. So you might say, well, we're gonna have up to 10 rack types. Here's the month that they go live. Here's the count of racks of each type that we have. Here's the rent per month per rack. Here's your utilization pattern. And note this pattern starts at the start month, whatever this is. So in this case, for type 10, we start month 35. So month 35 would be month 1 in the pattern. So there'd be 10% of these 20 utilized in month 35. So this is dynamic to the go live month here. You also have your annual price increase. So this is a starting price. And just like that's dynamic, this is also dynamic. So if you start in month 35, then year 3 would be your year 1, and then in year 2 would be year 4 of the model. You would have a price increase from this base amount. So the tenure of each type is measured. So we know the age of from when they each, essentially this is a cohort of rack types here. Now, revenue option 2 is you can charge for power consumption, and you could define the kilowatts of each rack type. This is the total kilowatts based on the count of racks of each type. Kilowatt hours max per month. You've got a PUE score, which the PUE score is saying, well, if you're just using this many watts for just the IT equipment alone, and you have a PUE score of 1.3, that means you're also using electricity to, for the lights, for cooling, for other things. So there, in the industry of data centers, this is measured in a ratio, and you can multiply the by that to get the actual expected electricity spend. So you know how much that is, and then here you can configure how much it's costing you per kilowatt hour, how much you're charging the customer, and then this is how much it's costing you in an annual price increase. Now, if you're including the charge for electricity in your base pricing up here, that's fine. You can zero out what you're charging to customers. Now, if you zeroed that out, you can see on the executive summary, there's now no power consumption revenue line. But there will be a direct cost still related to that power, because as you know, you're still getting charged by utility companies an electricity bill. So you're going to want to have this number in here, even if you don't have revenue, even if you're not breaking it out for each customer, you might be including it in this total amount up here, which is fine. Revenue option 3, cross connects. So you have faster connections between possibly multiple servers in the data center. And so this is just possibly another ancillary charge. Again, you might have it included in this all-encompassing number up here, which is fine. But if you want to configure it separately, you could do the count of racks, count of connects per rack type. This gives you the total connects, and usually these are just a monthly fee per connect. And we've got that there, as well as what it might cost for maintenance and other things to keep those connects provided to the customers. So there's some margin markup there. Even if, again, you might not include the revenue source, but you might include this cost, or you might include this cost elsewhere. If you don't want to do it by rack type, you can just always go into the OPEX here, and then under cost of goods sold, just other direct costs, you can define your expected annualized cost here and increase it over time in the start month of that. And one of these could be your cross connect labor or maintenance or whatever. You could define all of those items here, and it'll still hit cost of goods sold. So that's cross connect, and obviously the annual price increase of the $100 and what your cost increase by per year can be configured here for cross connects. And finally, managed services. So here we have the count of customers that are utilizing each service type. There's 3 here: remote hands, which is hourly labor, enhanced security package, and advanced monitoring. Now for remote hands, you're saying, you have a utilization up here of how many racks are actually being used over time. Then of those, you can say what percentage of those customers are paying extra for, hourly labor, and you could do the number of support hours per rack per month here. So this is the max for each cohort type, the amount you're charging per hour for labor to the customer, and the amount that the labor is costing you. So there's some margin that can be made there. And again, this could be separate. If you have this labor cost on other different contracts, you could put that in the OpEx tab as a fixed expense. You could even do it per rack here if you wanted to, per occupied rack or per total existing rack. And measure that and zero it out here. The other type, enhanced security, you're doing, again, percentage of used racks that utilize this service, the fee per month, and then you also have costs likely related to that and this is the cost per rack per month that you're putting in these boxes here. And advanced monitoring, same thing, percentage of customers that use advanced monitoring, what you're charging those customers per month, and then what it costs you to provide that service per month. And that's all on a cost per rack basis and revenue per rack basis based on the total racks utilized by that are using these special services. You can also control the annual price and cost increases for all 3 of these sections right here. And again, remember, for any of the extra add-on revenue and cost schedules above, if they don't apply, you can simply zero it out. Utilization, just a quick note, that goes for 24 months granular. And then after 24 months, you can define it by year. So like the first 24 months of a given cohort utilization, and then year 3 is just one rate, year 4, etc., up to year 10. Matrix, this is how all of these calculations are happening dynamically. OpEx, here we've got 3 different main fixed cost schedules: the start month, the annualized cost, and then some of them you could define it by percentage. So if you configure this, the cost increase by some percentage, that applies to the first set. And then the bottom half you could manually define if you don't want to change them, just with a flat percentage per year. Same for this section and this section. This is just costs as a percentage of total revenue to catch anything else that you haven't accounted for. And then we kind of touched on this. You've got direct fixed costs, sit and cost of goods sold, and you've got cost per occupied rack and cost per total rack per month. So this is, or sorry, per year. So this would take, this number divided by 12 times the occupied racks for the month. This would take this number divided by 12 times the total racks that exist here on the revenue, and it's 160 in this case. I would also make a note, for enhanced security and advanced monitoring, you might have costs in your Capex that went towards providing these services. And if you do account for that here in the build out, you don't need to also account for it here in your cost per rack per month. But this gives you the option to define costs on a per rack basis for each of these if needed, as well as obviously revenue. You could simply just do this up here, charge a flat rate per rack per month, zero out all these other revenue streams, and all the related costs, and then simply charge a certain amount per occupied rack per month here. Or sorry, per year. This is per year, and it'll be divided by 12 on the monthly detail. Let's go to the Capex. So this is just to calculate depreciation, what month depreciation starts, which could vary, and then the useful life in years, which will define how much depreciation is happening in the income statement. FTEs, full-time employees. Maybe you have other staff that you want to account for. You can do a start month number, account, annualized cost. Payroll tax and benefits is just a percentage of that. You could use this for all kinds of things, so it's just core logic is this is the annualized cost, some percentage increase for taxes, and that's it. And you can increase that over year over year. Loan one, so if you're trying to use debt, you could have a loan. This loan could be a construction only loan. It could be a construction loan that turns into an amortization term loan. You can define essentially the inputs up here. So in this case, I'm saying I'm going to draw $2 million in month 4. It's an interest only period of 12 months. So I got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months of interest. And then in month 16, I'm switching, which is 1 month after the interest only period ends. You want to make sure that that month of switch always lines up with the month after the interest only period ends if you're doing an interest only period. And then month of switch happens and that turns into this term loan with this, amortization, loan term, and interest rate. And then you have P&L charge there. So you've got total principal and total interest columns in T and U to calculate to see the grand effects of all these things. The model will assume all the loan is paid back at the end of the model month if this is selected as yes. If this is no, it'll just keep running till the end of the loan term, as you can see here. What else? So, it doesn't have to be interest only, and it could be a loan right up front. So let's say you did a $1 million loan that you're going to start paying interest on right away. You just say interest only period is 0. A month of switch 1, and you're just paying right off the bat. And it's a term loan, so you finish it off in 10 years. Or sorry, it's a 20-year amortization. If we put 10-year amortization here, it ends right at 120 with the principal and interest. So it could be all types of different loans you could account for here. It's very flexible. I'll leave this version in for now. Actually, I will leave in with the interest only period because that's a little bit harder, so you can see an example of what that looks like properly configured. You've also got 2 other loans you could take out for working capital or what have you. These are just regular amortization loans with a loan term, interest rate, and loan amount, as well as the month that is drawn on. Cap table. Here, the model is going to solve for the minimum cash you need to keep cash balance above 0. So this is like your minimum equity required. You can define how much of that's coming from outside investors versus inside. And on the model, I have the fill for the overflow here, meaning any amounts not entered in the bottom section or here that haven't accounted for this full amount, just fill into here, if any, and then you can put the percentage of the company that each investor is getting, and the total of these 2 columns should always add up to 100% when you added them together. So here we have 95%, 5%. You've also got cash flows going to each individual and total inside and outside, essentially investor or owner and their IRR. Other startup costs just hit in period 0. These might be legal fees or different setup fees that have not been accounted for elsewhere. Terminal values, not super relevant. Usually I just put this at 100%. It just means how your taxes are hitting on the exit if you're including the terminal value. Income statement. Now we are putting all those assumptions into something that makes sense. So all your different revenue from the different sources. Direct variable expenses, fixed expenses, and depreciation. Gross profit, OPEX, EBITDA, depreciation. Here's where depreciation actually hits for taxable income. In EBITDA, remember EBITDA is earnings before interest, tax, depreciation, amortization. So here we're actually adding back the depreciation and then taking it out here to get to a taxable income. And in this case, you can see the depreciation has resulted in no taxes for the first few years, and then until year 8, then we start to pay a little bit more when we're finally fully out of depreciation benefit. Balance sheet shows you on a monthly and annual basis your cash, value of the non-current assets, accumulated depreciation, debt, equity, retained earnings, and all that balances out with the accounting equation. Annual balance sheet, cash flow statement. This is kind of like your uses and sources. Discounted cash flow analysis shows the project as a whole up here, and the investor's view and owner's view, if you want to see that broken out, as well as the cash flow totals, discount rate, and net present value for each. Visuals, let me zoom out a little bit on this. So total revenue by year, gross profit without depreciation accounted for, EBITDA, gross profit margin, cash flow, annual revenue by revenue type, as well as occupied racks over time, EBITDA margin, total occupied racks on a monthly view, average monthly revenue per rack occupied versus live. So of what racks are live, how much revenue are you getting per rack? And of the occupied racks, how much are you getting on average per month in revenue? I mean, this is total revenue. Occupancy rate, monthly view, annual Capex, total assets versus liabilities, cumulative cash flow, and total assets versus liabilities, annual view. Zoom back in on that. Monthly detail, this is kind of where everything actually happens. This is the core source of all the calculations of the model. And note, you will see if I were to set this to say 60 months, and I go back over here, everything stops at the end of month 60 in this case. So that's dynamic. So you can adjust that however you want. But the monthly detail shows your rack counts over time, your occupancy rate, your revenue for each revenue type, your key metrics, variable costs for all the different types of variable costs. So here you've got your electricity, cross-connect remote hands labor, enhanced security costs, advanced monitoring. There were 3 costs for each of those, remember. So that's all dynamic. Other direct variable costs. Remember, we did based on utilized racks and all racks. Fixed expenses, fixed direct costs, sorry. And then cost of sales here for depreciation, gross profit, and then all your other overhead, corporate overheads. EBITDA, loans, debt, service, Capex, taxes, exit proceeds, and final cash flow. All connected, all showing nice summaries. And here's the annual view of that. And you can hit the little box up here on the top left to minimize and only see certain, the high level view of each row if you want to see that. Debt service coverage ratio might be an important one if you're using leverage. And that's the model. I think it's one of the most flexible templates I've built to date. It really goes into the granularity of the different ways a data center can make money and what it costs to get it started. And essentially it's just based on a utilization of available capacity over time. And you can get simple and high level by charging a simple flat out revenue per month per rack and have a cost per month per rack. Or you can get granular and define, these different individual revenue streams by rack type if you want to break that out. I think it's one of the best models I've gone through. I really like the functionality and flexibility of this thing. If you want to get it, you could download it over at smarthelping.com. I did update my homepage a little bit, made it so it's faster. Anyway, this model would be in a couple places. One, under the SaaS subscription and tech models, because it'd definitely be tech. Now, it wouldn't be under as a service. It would be more under a fee-based model. So I'd put it in with these, and I'd also put it in the industry-specific model bundle in probably, it's kind of, so it kind of hits on real estate as well as tech. I'd probably put it in this real estate group here. Now I've also got a real estate bundle that has all kinds of underwriting tools. So it's going to be in a couple, it's going to be in three main bundles. It'll be in the real estate. So these right here, SaaS, recurring revenue, tech, real estate, and general industries. It'll be included. You can buy any of those bundles and get it, or you can buy it individually. Now pricing on this, I think I'm going to go $75. I think is a fair price for this simulation. Um, so check it out. And again, you can buy all my models if you want. Get the Super Smart bundle right here for $4.99. This includes all the templates on the whole site. If you really want a broad library of financial model templates. Alrighty, like and subscribe. I'll see you on the next one.